Hello and welcome to Mint. I am Sara Khan, and in this edition of From the Newsroom, we are joined by C.H. Krishnan. Thanks for joining us, Unni. So, in today's topic, we're going to talk about the Bombay-based pharmaceutical company Wockhardt that had applied for CDR in 2009, post its poor financials in 2008. But since then, it has come a long way and has regained investor confidence and has healthy financials. So, Unni, tell us what went wrong with the company in 2008?
Thank you, Zara. It's in 2008, Wockhardt Limited, one of the top drug makers in India, had its worst financial crisis because of a huge loss they posted in some of their derivative transactions with the foreign institutional investors as well as international banks to cover the forex loss, or maybe it's a kind of the hedging the currency fluctuation in their international transactions. And because of the currency devaluation, the rupee devaluation, there was a huge mark-to-market loss in all of these transactions, and the company posted around a loss of around 600 crore. Compared to the turnover of a company of this scale, 600 crore loss was a huge one, and the company hasn't really expected this. Because of this, also they posted net losses for the consecutive 8 quarters since then, and the company also had to face lots of debt defaults, loan defaults, and also the company which had raised foreign currency convertible bonds in 2004, which was due in October 2009, was also got defaulted. So this was the crisis the company went through, and in 2009 they were forced to go for a corporate debt restructuring with a group of its lenders, mainly ICICI Bank Limited. And after the CDR, company had to adopt such a strong financial discipline as instructed by the CDR. And then because of the strong operations in international markets as well as domestic market, the company could do well, and also luckily the market grew because of lots of other factors. That company could come out of most of the immediate liabilities, and also the company, as part of the CDR, it had to sell off some of its non-core assets, like one of their international operations, which is in Germany, which is called Espama AG. Then again they sold their animal health business internationally. Then later the company sold off its nutritional business to a French company, Danone, for a high premium deal. All this put together, the company could raise adequate money to meet all the immediate liabilities, and the company now says it can even exit from the CDR at an earlier date.
So what do we see the way ahead for the company?
Now, one of the important strategies what they have adopted now is they have stopped investing in derivative transactions. It was instructed by the CDR, and for the last 3 years the company hasn't put any money in derivatives, and the chairman Habil Korakiwala now says he will never touch derivatives because he had learned hard lessons from the past, and the forex cover will be taken care of by the export-import balance of the company's transactions.
Thank you so much for sharing your insights with us, Unni.
Thank you.
On that note, we end today's episode of From the Newsroom. For more updates and to read Unni's full story, please log on to livemint.com.